I'm Michael Fox, and this is the Prospector News Podcast. And I have joining me again after seeing him in Miami and sunny Florida back last month. I have Mike McGlone, the Senior Commodities Specialist with Bloomberg Intelligence. Welcome back, Mike.
Thank you for having me back. It's good to be back, Michael.
Yeah, lots happened since Miami, which seems like we were just together down there yesterday, but a lot of water under the bridge. When we were talking in Miami, gold had made a move up and looked like it had moved up the step ladder and changed the bottom and the top. And since then, it's made another move up the step ladder. And so the question I have is, has it moved up the step ladder, or are we just looking at just kind of an interesting breakout here?
Yes, it's doing both. It's doing both. It's a bull market. Compared to virtually every other commodity, it's the only one really making new highs. And I look at this latest level around 2,200, $2,200 an ounce is, it's a record high. But the key thing to think about gold is to me, I don't know what stops the bull market. I can see a lot of reason for it to keep going. Now, we did have a decent dip early in this year below 2000. You kind of need that sometimes in bull markets. You have to make it difficult. I thought it'd be a little bit harder. And the key thing I like to point out is we haven't had a decent backup in the S&P 500 since that low in October. So at some point that's going to come. But the macro for gold to me is just tremendous. And so let's look at first performance. If you look at GLD on a total return basis, the top ETF is up about 18% since the end of 2021. And the SPY, the total return, is about 13%. So gold's beating the stock market since the end of 2021 with lower volatility. And what's also significant is, yeah, I picked the point in time, but I think I'll just point out, to me, the world changed in 2022. And for two key reasons. We had the unlimited friendship start between President Xi and President Putin, and then the Russians' invasion of Ukraine. Now we've had another war commence since there, and that's Israel, Hamas. And we've had the biggest, sharpest, most significant rate hikes on a global basis ever. And in that environment, it seems like, well, okay, that's a decent catalyst of gold to start outperforming the stock market. It has, with a lower volatility, and I think it's just the beginning.
Yeah, it's amazing. You think, this is those factors have been going on for a long period of time, and the reality, it's only really been a couple of years that we've had to deal with that kind of a new world order, so to speak. Now, when we take a look at gold, we used to talk about a floor at about 1900. You and I talked about maybe the new floor was 2000. There looks like we don't know where the upper end of things are, but do we have any sense of where the floor might be now?
Yeah, I think it's 2000. What was resistance is now support. We've had that one little dip this year below 2000. You got to flush out some of those weak longs, get out some of the leverage people. And now I let the people who watch it more closely than I do. I just look at the next key levels is 3000, goes to handles. That's what gold typically does. And sure, the thing is that the level just a few weeks ago was the same as when it first started trading in 2000 and 2020. So it was basically unchanged for 4 years at the beginning of this year. So it's got a good, you call that a good base of consolidation and time correction. And the big difference from the last time it had a big breakout, which was, I think, when it broke up to 1,000, we had the financial crisis drop to 700 and then went to 1,900, is that big move was rather rapid and had made so much progress before the great financial crisis, it had to back and fill. Now we don't have a lot of room to back and fill. So technically it looks great. And to me, the fundamental situation is the deepest pockets on the planet, i.e. central banks led by China, are buying gold and accumulating gold, and not just the central banks, but citizens of China. Where else are they going to go? And we have this significant potential reversion in that country. So I don't think you can go to gold anymore without pointing out what's really happening in China. I think it's just a way overdue, rapidly emerging market that's mean reverting. It just needed some of that. Japan did it in the 80s and finally is catching up now. So to me, that's macro. But what's also most significant, I think is going to be flipping soon, is ETF flows. Gold ETF holdings have been declining for almost 2 years, almost on an unprecedented scale with the price going up. So the price is showing significant divergent strength to outflows in ETFs. And I think to make at some point those flows will turn to inflows. And I think what it's going to take is for people to say, okay, well, stock market is not as attractive anymore and T-bills are no longer 5%. So you see the bent there. I think gold's picking up on that. But the key thing I always like to point out is in the world going digital, might be very risky to be focused completely on gold without some digital gold, Bitcoin in that space.
Yeah, that's a good lead into my next question. Is gold has taken off here in the last 2 to 3 weeks. We've had record daily highs. We've had record weekly highs. We have the potential here a week from today having a record monthly high in gold. And all this has happened in a very short period of time. When is gold waking up and seeing that the rest of us are maybe oblivious to?
Well, I think it's pricing in what's going to be happening in the future. At some point, we will have rates in the US coming down, and we'll have some reversion in the stock market. And that's been the key competitor for gold. I mean, why buy gold if the US stock market's on a tear and you can get 5% in T-bill? At some point, that's going to see reversion. But one thing that's also been happening, this is Q1. In Q1, we've had record highs in the stock market, and just a day ago, S&P 500, and right now as we speak, record highs in gold and record highs in Bitcoin. At least I don't think they're all going to win this year. I think I'm fearful and I'm afraid that gold is going to outpace the stock market this year, and it's on that pace. So as we speak, S&P 500 is up about 10% on the year. Gold's up about 6%. Of course, much lower volatility in gold. But to me, the trigger that gold's looking ahead to, the trigger will be when we do have some kind of back and fill in the stock market. That's the number one test I'm looking for in all commodities, because let's say if you're looking at crude oil, looks near the upper end of the range, it just tested $83. Copper looks like it's the upper end of the range. It's just got to a 4 handle. If you're a trader and you're running leverage futures, which is my background, you look at your value at risk model. I think your key risk is the stock market goes down, and we haven't done that in a while. So I look at it. It's the end of the first half. It's been a great year already for the stock market, up almost 10%. And at some point, you always get those little 10% corrections. That's what I'm waiting for. And I think gold's anticipating that. Just give us a normal pullback and let's see how gold reacts. But I think it's also the world order shifted. And the next key, I think, domino will be when we have some more recessionary type leans in the US. And most of my data tilt that way. And we can go there if you want, but I'll end with this. We still have a significantly inverted yield curve, stuff that used to matter. Leading indicators are still very negative. That's worked 100% of time since 1960. And then, well, just look at the pendulum swing in sentiment. A year ago, the stock market, U.S. stock market, was at about a 20% discount from all-time highs, and the sentiment was for a recession. Now we're at all-time highs, and the sentiment is we won't have a recession. Just a little pendulum swing backward in that sentiment is, I think, what we should expect as we head towards into Q2.
Yeah, I'm personally unsurprised that we haven't gone into recession already. There's a lot of indicators that are flashing red lights saying that we should be going into recession. I think for the poor 60% or 66% of the population, they feel like they're in recession already. Their sentiment tends to be very negative on the economy as it's moving forward. But at the same time, we say all of that, let's take a look at, what I consider recessionary commodities that, are counter-indicating what everything else is, and that's oil and copper. They're, in the last few weeks, they're both up.
Yeah, so that's why I look at it as, okay, this is time to test it. If you're a trader, and I try to navigate both. I used to be an ex-trader, and this is where you say, okay, fine. If we are breaking out of this malaise period globally, and China's coming out of this and doing fine, and going to do fine, and Europe's going to do fine despite the fact they haven't even started easing yet, that's great. Then this is a test. So I look at it as copper is near the upper end of the range, crude oil is near the upper end of the range, and it's worth testing the market by, i.e., testing shorts. Now, I don't give investment advice, but that's kind of the kind of things I would hint. I think that the market traders are doing, and then let's prove that strength. So some of the key recession indicators I like to point out is I mentioned leading indicators remain negative. Retail sales in this country, ex CPI, are the lowest since basically the financial crisis. We have a period of retail sales, if you exclude inflation, are actually negative. And then there's things like diesel demand. Diesel demand in the US is the same as it was about 10 years ago, 2014. It's well below the highs. That's the grease of the economic engine. That's clearly recessionary. We've never really had that without a recession. Of course, my data is only really about 30 years on that. Corrugated boxes, container board boxes, that demand has been dropping at the same velocity it did during the Great Recession back in 2008 and 9. And here's one of the things I think that's most significant on a global basis is bond yields. You look at bond yields in the number 2 economy in the world, in China, they're basically half what they are in the US. So here's a metric I started doing. I started using, and in US is much higher. So the world is tilting towards recession, and that's probably going to show up in industrial metals. Now they're bouncing a little bit, i.e. copper, but also there's been some supply constraints in copper and issues in China. But the key metric I like to use, if you take the US 10-year note yield, it's about 4.3%. And you take the average of the next 4 major economies, that's China, India, Japan, and Germany. They, on average, right now, the average of those 4 is about 115 basis points below the US. So the bond markets are showing deflationary, recessionary bents. And the question is, will the US be able to pull the whole world on this? Will the stock market be able to lift all boats? And to me, that's where the inordinate burden comes in. And that's where I think gold is starting to figure it out. And that's where I think the risk is we just have a little bit normal correction in the stock market, and we'll get that test to see if this is the tilt towards recession. But right now, I'm very much concerned that we're in that blow off top phase in equities in the US stock market. And then you also look at things like China. The Chinese Hang Seng Index is the lowest versus the U.S. since when Chairman Mao was president in the 70s. So it's a major dichotomy between the U.S. and the rest of the world. And the key trigger is I just don't know of any time in history we've had that much of a burden of the U.S. stock market to rise to lift all boats. So to me, that's what's happening in the macro. That's what's happening. And one thing I'll end with is bond yields. It's just look at China's yields are around 2 handle, 10-year notes, and U.S. is around 10. Why is that? Because the Chinese have had to do massive fiscal and monetary stimulus to help boost their economy, and they're completely dependent upon that succeeding.
Yeah, and then we're recording this on Thursday, the 21st, the day after the Fed released their data and everything, and they came out with no interest rates again. They suggest that they're still going to remain higher for longer, and all the markets again have shrugged that off. Are we asking the Fed and the American economy to do too much heavy lifting here?
It seems to be a bit of a double dog dare at the moment. The Fed's dot plots, and the chairman says they plan on easing in the near future, particularly if unemployment ticks up. Unemployment is ticking up, and inflation continues to tick down. But let's look at what's happened in the last, just this year. Inflation has ticked up on the back of the stock market going up. So there's that wealth effect kicking in and actually becoming potentially the stock market becoming its own worst enemy. The high price cure that affected commodities in 2022, and it's still affecting them, might tip over to the stock market. And to me, that's what the issue is with the Federal Reserve. I think right now, from a Federal Reserve standpoint, most of their inflation metrics are about double their targets, and they're ticking up lately. They have see a pretty massive speculative frenzy in the stock market and things like Bitcoin and cryptos on the back of them. Markets anticipating ease. When you're the Fed, you look at that and like, well, that's not an environment to ease. You just don't. It's silly. You don't throw more alcohol in the punch bowl when the party's getting out of control. And right now it is, short term. So to me, that's the problem. That's why I think gold's figuring it out that this is the stock market potentially being its own worst cure, own worst enemy. It's high price cure. Every time it goes up, inflation picks up and Fed easing goes out of the market. So here's one issue. Right now, in the year ahead in futures, Fed fund futures I like to watch, we're priced for about 100 basis points of ease. And that's what has kept things bid in terms of equities. They're anticipating that liquidity coming in. But like I said, inflation's above the metrics. And I'll just end with this. Fed fund futures in this cycle first started tightening pricing for 100 basis points of easing at the beginning of 2023 last year, and the Fed hiked 100 basis points.
Yeah, and they're talking about at least the market is talking about the Fed dropping in the next Fed meeting, but that's not what I heard the Fed say. They're thinking they might drop some point in the future, but they're not making it sound like it's that close. Is the market apt to throw a temper tantrum when they don't get their way in the next 6-8 weeks?
Well, I think that's a key thing. I'm glad you mentioned it. I don't think the Fed should ease until the market tells them to by going down, because the market going up is upticking inflation and it's showing a massive speculative frenzy, and that's not an environment to typically ease. If they do, it might be considered irresponsible.
So I have another question. I'm curious to get your response of. We didn't talk about this off mic, so this might come out of left field at you, so I apologize in advance. But I look at things like the consumer purchasing index. I look at things such as the unemployment index, and I look at an aging population. And older people tend to buy less things. They also tend to retire and remove themselves from the job market. How much of the stagnation in consumer purchases and the the low unemployment numbers is a factor of demographics versus economics?
Yeah, that's a good question. I think the key thing to point to that, you pointed out some very deflationary forces, and that is the boomers retiring, but I hear it's like 10,000 a day or something like that. They're well past their prime earning years, and typically they go to fixed income, or as the crypto people say, boomer rocks. They buy gold or hold gold and use stores of value, and they should be getting out of the equity market, but most of them aren't. Most of them won't get out until the market makes them get out, in my view, partly because it's just the human nature to ride good bull market. So what I see happening is, first of all, the facts of retail sales. I love to compare them versus CPI. I published on this recently. I pointed out, it called it the stuff that used to matter. Year over year retail sales in this country minus CPI is negative 1.7%. They are down if you compare retail sales to CPI. That hasn't happened. We haven't had negative retail sales since we had the pandemic for a little while, and the most recent example was the great financial crisis. And if you compare that with Fed funds, running 5.3% or so effective rate, that's a very high effective Fed funds rate for negative retail sales. So then I point out things like diesel demand, unleaded gas demand, paperboard boxes, all that stuff is clearly recessionary. But we have the wonderful AI and the stock market just taking off and pricing, and I think getting to a silly stage, pricing in ease. So to me, this is where the risk is, and it's keeping people feeling wealthy and willing to spend. And at some point that will probably shut off, because this feeling of wealth and willing to spend is keeping inflation high, and that's keeping the Fed from easing, which is, you see the cycle there might be pressuring risk assets. So it's a very unique stage, but it really makes, I think when you look back at this from the future, we'll say, well, that made a lot of sense after the historic distortions of the pandemic, the biggest liquidity pump in history, then the biggest, sharpest liquidity dump, and the two wars that have kicked in. It's just major distortions, but the big picture macro to me is quite unfavorable. I'm sorry, I'll end with this. The key thing I hear from a lot of people, I don't use this metric so much, and then you have this exceptional extreme U.S. exceptionalism. The most I've heard the number used that the U.S. stock market is in the 95 percentile of how expensive it's ever been in history.
Yeah, it keeps going up and up. And speaking of things that keep going up and up, let's talk Bitcoin here a little bit. ETFs have now entered the scene with Bitcoin, and an ETF works on fractional banking policies. So they have to hold reserves and as a percentage of what's invested in the ETF. Unlike, like a gold or a silver ETF where people can essentially be, trading their reserves on a futures market, you actually have to have the Bitcoin. Is what's happened in Bitcoin in the last several weeks since the ETFs got announced, is that the ETFs buying Bitcoin to meet the reserve requirements, or is this a new leg up for the Bitcoin market?
Both,
Um,
both. It's increasing demand and adoption, definable diminishing supply. By rules of economics, prices must go up over time. So first I'll point out that the Bitcoin supply will be cut in April in about a month. It'll be cut from an average of from 900 new coins a day that were mined globally to 450, set in stone. Boom. That's all you have to say about that. It's going to go. And then another 4 years from now, it's going to drop again. But the ETF demand has been quite significant. I show we've had inflows of around 11 to 12 billion dollars in just a short period of time. And that compares with outflows of gold ETFs of about 20 billion over the last year or so. And so to put this in context, total ETF holdings now in Bitcoin around $70 billion, and total ETF holdings in gold are between about 100 and 184 billion. So Bitcoin ETF holdings are catching up really quickly to gold ETF holdings, almost 40% now. I think it's just a matter of time. They will catch up. But the thing to remember is Bitcoin's about 3 times the volatility of gold and the S&P 500. And when we do have that next drawdown in the stock market, Bitcoin, which has been called the fastest horse in the race, probably still has a higher correlation to the stock market than gold does. And I think that's where people are looking forward to. But the key thing to remember about Bitcoin, it is a revolutionary asset. It's very nascent, and it's just got kicked into the mainstream. And the bottom line from a commodity guy standpoint is it has definable diminishing supply, increasing demand and adoption. So overall, what it does in the meantime can just, make you lose your hair. You can't see me visual, but I don't have much of that left. So I just look at it, just it's going to fluctuate. But overall, the big picture for it remains quite bullish.
you mentioned about cutting back on the amount of Bitcoin that can be mined. With the ETFs, is that even relevant anymore?
No.
Because the ETFs, essentially have Bitcoin that doesn't exist within their, just like they have gold that doesn't exist in their ETFs.
Well, no, they physically hold the gold, and they physically hold the Bitcoin. They hold that, well, the virtual, and they hold it in wallets. I mean, when you own and manage an ETF, and you have someone come in and buy the equivalent of, let's say, 1 Bitcoin, you have to get that Bitcoin and put it in storage. And the key thing is the amount of ETFs buying in Bitcoin ETFs is basically made up for all the ETFs have been mined in this past and during this period of since, was it December 10th since they were first launched. So it's just virtual, though. It's just a digital asset. It's just how the world's shifting to intangible assets and digital assets, and gold is still the old tangible analog. Now, I'm not bearish gold. I'm still bullish gold, but I like to say is I think for old school and investors in gold long term in gold, not having some Bitcoin in its spaces, I think, is an inordinate risk. I'll just put it this way: if Bitcoin didn't exist, gold, I think, would be much higher than it is now, because there is an alternative now to gold for people who need it for that protection, store value, transmission, transact, and to be able to transmit, transact, and transport value over time. Now, it's highly volatile, but it's the volatility has been declining versus gold for years, and what it was about 10 times the volatility versus gold is now about 3 times. In the next couple of years, it'll probably drop down to 2 and closer to 1.
Yeah, I had an interesting experience last fall. I was at an event called the Silver Symposium, but there was a lot of crypto. It was held in Las Vegas, early part of October last year, and there was a lot of crypto at the event as well. So, they mockingly referred to gold as boomer rocks, so I
Yeah.
mockingly referred to them as crypto kids. But the interesting thing that I found out of that show was that before it was Bitcoin or, it's not Bitcoin or anymore, it's Bitcoin and. So
Interesting. Yeah.
they're making their profits on the volatility of the cryptocurrencies, but they're preserving their profits using gold and silver now.
Yeah.
Is that, if that becomes a trend, does that bode well for the precious metals?
Yeah, it's good. I like that. I mean, it makes sense. So if you buy an asset, invest in an asset, and it goes up 10x in a short period of time. If you don't skim off some of those profits, one of the lessons I learned working in the trading pits, if you do not give the market, feed the market a little bit of your profits, the market will rip them out of your hands the hard way. They don't mess with the market gods. And where do you put that? Well, precious metals are perfect. I think it's a good space and store value. And I don't really think silver anymore is that. Silver is much more of an industrial metal now. Some of the PGMs are quite low. I mean, platinum and palladium got pretty low. Diversification there makes sense. And then, of course, there's good old T-bills making 5%. I mean, that's part of the reason I think you see the number one traded crypto asset is not Bitcoin. It is the dollar via Tether, the Tether dollar token. And its AUM now is over $100 billion. So a lot of those profits are being cycled back into dollars, and that's also one of the biggest holders of treasuries on the planet. And these are stable coins, are called crypto dollars, but it's just where this technology is going. It's unstoppable on a global basis because it's just better. It's just like ETFs, and a better way to transact and transmit and transport value. And it's just like the example of a crypto dollar, as I like to say, is if you in any country in the world, you can get access to the dollar now via your phone, and you can even and companies like Visa and MasterCard can settle those transactions or move those dollars instantly for virtually no cost. Typically, for a company like Visa to settle their dollars, it usually is maybe 4 days a week they can do it because of holidays, and it takes a couple of days to settle, and it costs a lot.
Yeah, well, that's the old school way of banking. I'm shocked when I can transact stuff digitally so rapidly, but if I actually have to deal with my bank, it takes a week. So
Yeah.
it's one of those things. So as we wrap this up, then we're still bullish on gold.
Oh yeah.
A
Yep. Yep.
recession this year, yes or no?
Um, I tilted towards yes, unfortunately, in part only because the market's tilted completely the other way.
And one thing we didn't talk about was the actual commodity miners. What's going to bring interest back into the commodity miners? Just continue
Don't
higher
know.
commodities?
I don't know. I'm worried about that whole situation because that was the key theme at the metals and the money conference, um, mining and money conference, and don't really know yet because what I'm concerned about in the equity side is if the miners are basically have a beta to the underlying miner, commodity, obviously the metal price, the gold price, and also a beta to the S&P 500, the stock index. I am worried if the equities do underperform in an environment when the stock market's making all-time record highs. I mean, S&P 500. What happens when we do get that final correction in the stock market, which we're overdue for? Just a little 10%. In October we had a 10% correction, and that kind of set the stage for where we are now. So I'm concerned about that, but I think the key thing is, from my standpoint, is I still see very bullish inklings in gold, and it's hard to be bearish the miners, but it's still the underlying metal that's leading the way here.
And the market itself, you see just a correction, or do you see it tilting into a bear market?
Oh, it's going to be a bear market sometimes, but I want to get to that first bridge. And the first bridge is just give me that 10% correction. Let's see how things react. So, for instance, I think it's worthy of. Crude oil looks like it's at reached a pretty good high around 83. Copper, I think, has reached a pretty good high, and like we mentioned earlier, and if we just stay at that little correction in the stock market, that probably should bring all the boats down, and then we'll see how we shake it out. So that's where I'm worried that this is kind of a silly stage for equities, and plus it's the end of Q1. It's not like the end of Q3 or 4. It's Q1, and there's a lot of year ahead here. We have an election. And like I mentioned, from a lot of my indicators, the market's just too frothy, stock market, and gold might be picking that up.
Perfect. If people want to follow your musings and your research, how would they do so?
I'm on LinkedIn, Mike McGlone at Bloomberg Intelligence, and on Twitter, it's at Mike McGlone 11. And I'm happy to add people to my distribution list if they want to reach out and give me their email. I'll do that. I just recently published my gold crosses. Note, comparing gold to virtually all assets, and I just point out that Milton Friedman's rule that inflation's a monetary phenomenon always really shows up when you compare almost all assets to gold. For instance, agriculture prices are just melting over time versus the price of gold, yet in dollars they go up.
Yeah, gold is always the stable thing to compare everything with. I appreciate you taking the time to join me again today, and I look forward to having you on again very soon.
Thank you, Michael.
Take care.
You too.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.